I've gone through all kinds of different systems where they said, well, yeah, you can predict 80% of the increase in the price of a stock, or you can predict the price of a stock 80% of the time. Okay, well, yeah, maybe you can predict it 80% of the time, but what about that other 20%? And then how do you trade that? So what we're doing is, by creating the types of trades that we're going to be putting on in the system, we are giving ourselves a huge potential to profit, because we don't have to predict price anymore. You know, the price, once we put this type of a trade on, it doesn't matter if the stock goes up or the stock goes down, because it could go down to 69, and guess what? We still get our full potential profit from this system. The only problem that we run into is when the price starts to come down, either towards our lower strike price or at the higher strike price. Then what we do is simply adjust. All we have to do is adjust our prices and adjust our contracts to take advantage of the new opportunities available to us if the price of the underlying stock reaches our break-even points. We never really have to be too concerned about price. And that is one of the biggest hang-ups, and one of the reasons why the majority of people do not make money in the stock market. They are only playing price. And the only rule of the stock market, as I said, is that prices fluctuate, and that's all. And we cannot predict the future price. So once you put on a trade like this, the most important thing that you should understand is it will probably need adjustments. In other words, you're not going to be able to put on this position, and this is the way the majority of people who lose in the market do it. They put on a position like this, they leave it alone, they never see it again, and all of a sudden they look at their trades and they see that all of a sudden the index is trading at 78 and they're at their maximum loss position, and they say, this doesn't work. You know, the technical term for this type of a trade is we're selling an Iron Condor. And you know what? They're going to say, that doesn't work. I've done Iron Condors because, you know, boy, I put these things on and the price moved against me, and all of a sudden I'm at my maximum loss point, and I did it 3 or 4 times, and I'm never going to do them again because they don't work. Well, the reason that they don't work is because you don't manage your trades. There's one of the CDs that we're doing, of course, is on portfolio management, and we're also doing one on adjustments. Take a look at those. Take a look at what happens in a live trade, and that's the one thing that separates us from a lot of people who are teaching different strategies and so forth, is that we will show you live trades in our demonstration account. We're putting real money on the line on these things, and we'll show you exactly how to adjust them. For example, in one of the videos that you're going to see in the adjustment CD, I show you a SPY Iron Condor. Now, SPY is the S&P 500 Spiders ETF, and I'll show you that real quickly. And what happened was we put a trade on right down here, right when it was around 133.5, and all of a sudden it moved dramatically against us. And we had set our short call option up near the 140 level, and we almost got nailed right up against our 140 call. And we didn't get hurt because we adjusted it. Take a look at that to see how you can actually, and the reason that people do not make money in the market is because they don't know how to adjust. They put the trades on, they forget about them, they take the losses and move on, or they put them on, they adjust wrong, they adjust their trades in a wrong way that gives them an even worse position than they had originally, where if they left the position alone, maybe they would have been okay, but they adjusted it in the wrong way and put themselves in some danger here. So we want to try to avoid that as much as possible. Let's take a little bit closer look at this graph. The analysis tool that Thinkorswim gives us is really a great tool because it allows you to take a look at exactly what the picture of profitability of this trade looks like. If this trade goes to expiration, which is the third Friday of May, and the stock stays, this index IWM stays in between 74 and 68, well, we make our maximum profit. How do we tell what our maximum profit is? If we move our cursor along this line, we can see right down here that the green line is the date of expiration, which is 5/17. We will make a maximum of $46 on this position. What happens is our current profit and loss is this white line. That's the profit and loss as of today on April 20th. Well, you can take a look at this and you can say, well, gee, we're right at 71.67 on the index, and our profit on this position, if we hold it all the way to expiration, is $46. But our current, even if we put this on today, we immediately lose. And you can take a look down here. We immediately lose $2.93. How can we, we just put this on. How can we lose the very first day? $2.93. We've already lost $2.93 on this position. We just put it on. Well, remember that when we take a look at this again, is that the difference between the bid and the ask is the reason that you are never in a profitable position the first day that you put these on. Because you're selling these at 78, well, in order to close the position, you have to buy it back. So if you sold these at 78 cents and you bought it back at 82 cents, what's the difference between those two prices? It's about 4 cents. You're immediately losing 4 cents because of the bid-ask spread. That's what they call this, the bid-ask spread. So if you sell it at 78, you have to buy it back at 82. That's a 4-cent loss. You're buying the 75 calls at 50 cents. Well, if you wanted to sell them back, you'd only be able to sell them back for 49 cents. You lost a penny on that one. So you lost 4 cents on that one. You lost a penny on that one. There's 5 cents right there, and that's only one side of the trade. If you go to the other side of the trade, you've lost another 3 cents there, 4 cents there, and another on the 67s, you've lost another 3 cents there. So altogether, you've lost about 12 cents. Well, 12 cents times 4 contracts times 100 is close to $6. So you're lucky you're only losing 2, because actually, if you went into the market right at this moment, you'd probably lose 6. So that's why you would immediately lose money, and the reason is the bid-ask spread between the options. But that's okay. That's to be expected. Every time you put one of these positions on, you're going to lose money the very first day. But what we want to do, and what happens is, remember, there's 2 absolute rules of option contracts. Number 1, they will fluctuate in price. And the reason that we've put on a spread like this is because we've given it a lot of room for the price to move around in. It will fluctuate in price. So we've given it lots of room. The second absolute rule of option contracts is they expire. So what happens is today, yes, our option contract looks like this, our profit and loss looks like this, and we've lost $2.93. But over time, look what happens. This is today, the white line. This green line now has turned is about a week from now. Now, a week from now, all of a sudden, if our price remains relatively stable, all of a sudden we have a profit of, where is it? $4.15. Then, if we go all the way out to May 4th, which is just a couple weeks away, our profit is now $14.75. The options, remember, the options will expire. So, the further out, let's say if you buy a 90-day option, an option that expires in 90 days is going to be worth more money than an option that only has 30 days left to it, right? Because the closer you get to expiration, the less probability that that option will actually have any value if the price remains relatively stable. If the prices, of course, prices do fluctuate all the time, so that priced option contract is actually going to be worth more money at one point and less money at some point. Then, as we get very close to expiration, like 30 days prior to the expiration, well, all of a sudden at that point, then prices become, the option contract loses value on a daily basis.